Good morning, everyone. Good morning. Good morning. If you are here, you kindly drop your comments and let us begin our class. So, welcome to today's lecture on principles of accounts. Yeah, principles of accounts. That's what we are discussing today. Yeah. On principles of account. All right. So, in our previous lecture, we talked about. All right. In our previous lecture, we talked about principle of double entry and all that. We were able to complete double entry. We talked about the trial balance. We also talked about correction of errors. Right? We talked about correction of errors. So now we are moving to another pretty interesting topic, which is cash book and petty cash book. So we want to talk about what a cash book is and what does it mean for us as somebody preparing for exams. All right, so we'll just be focusing on those aspects that will be just be telling us how important it is generally for your exam preparations. All right, now just as the name implies, cash book, cash book. Now, based on the name, if you are told to describe what a cash book is, what would you say? Based on the name, if you are told to describe what a cash book is, what would you say? I'm pretty sure you would say that a cash book is a book that records cash. Abi, you say any book that is used to record cash is what is called a cash book, actually. And as funny as that might seem, that's generally what a cash book is. All right. As very funny as that might seem, that's actually the definition of cash book. It is as simple as that. Your cash book is a subsidiary book. Now, don't forget, um, while discussing, While discussing cash book and source document, I told us something. I said your cash book is your cash book is both a subsidiary book and what? And your cash book is both a ledger and a subsidiary book. Right? That was when we were talking about in our second lecture on principle of double entry, while talking about source documents, subsidiary books, and other um, books like that. So we mentioned that your cash book is both a subsidiary book and what and a ledger, which means you can call your cash book an account and you can also refer to it as a book. And actually, that is why it is called the cash book. Is that fine? That is why it is, should I say, fondly called um, cash book. All right. Now, your cash book is a financial journal that contains, right, if you are with me, can you kindly just let me know if you are here? Can you kindly let me know? Alright, let us just move on with the lectures. Alright, now what's a cash book? A cash book is a financial journal. Alright, don't forget that when we are talking about subsidiary books, you say subsidiary books is the place where you initiate your double entry. Alright, your subsidiary books is the place where you first record your transactions from the source document. It means that your subsidiary book actually receives transactions directly from what? From the source document. Is that fine? All right. So instead of you, the subsidiary book is the book that it is called the book of original entry. Don't forget, it's also called the book of original entry. It's called the book of prime entry. And what does prime mean? When you are talking about prime, you are talking about first. All right. So your subsidiary books are the first books of account where your transactions have to enter before they enter into anywhere else. That is the ledgers and all of that. Is that fine? So it is your cash book that first what? That your transaction first passes through. Is that taken? All right. Now, how does this affect us? It means that when we are talking about cash book, we are talking about a particular journal, subsidiary book, day book, book of original entry, book of prime entry, where cash transactions have to what? Have to pass through. Is that fine? Where cash transactions have to what? Have to pass through. All right. This means that your subsidiary book, your cash book is a just as I mentioned here, your cash book is a financial journal that contains all cash receipts and disbursements, including bank deposits and withdrawals. It is the main area where businesses record any and all cash related information. Entries are normally divided into cash payments and receipts. All of these are posted in the company's general ledger, and no credit transaction and no credit transaction should be treated in your cash book. Is that taken? Now, what that means is that for your cash book, you have any item in the business that actually involves the movement of cash. You see, whether you are paying cash or you are receiving cash, anything that involves you actually paying cash is what? is recorded, or it has to pass through your cash book. It has to pass through the cash book. So your Now when we say transactions involving cash, we are not just talking about physical cash. We are talking about transactions that involve payment. Transactions that involve what? That involve payment. It means that whenever you make any transaction and money is paid, right? If it involves you receiving money, then that is, it has to be recorded in what? In the cash book. So your cash book is that particular subsidiary book that records or that tracks the movement of cash. So when you are talking about the purpose of the cash book, then you know that it does what? What it does is that your your cash book tracks the movement of cash. All right. So it is your cash book that tracks how cash moves in a particular what? In a particular business. So whenever you pay cash, you receive cash, and all of that. Everything falls on the everything has to what? Has to pass through the cash book. Is that fine? So generally, when you have cash book, of course, for cash transactions, you have receipt, you have payment, and all of that. All right. So whether they are receipt or payment, they have to what? They have to pass through the cash book. So your cash book, one of the things that you must note, as I told you under in our previous lecture while discussing about source document and subsidiary books, was that you must know something, that your cash book is both a subsidiary book and a ledger. You must know this. Your cash book is both a subsidiary book and what? And a ledger. So when you are talking about cash book, they can ask you a question like this. I'm trying to draw your attention to questions that they ask, that they ask, and that actually sounds very confusing for a lot of students. Right? So you must know that your cash book is what? It is both a subsidiary book and what? And a ledger, which means it is both a book of original entry, in the sense that transactions start there first. Then it also forms part of the double entry. Is that fine? It also forms part of the double entry process. And any account that has a debit and credit and forms part of the double entry process is classified under what? Under ledgers, because your ledger is what? As we explained in our previous lecture, your ledger is a group of accounts. All right, it's a book that contains group of related accounts. Is that fine? All right. So that's for cash book. Now let's talk about um different types of cash book that we can have. All right, you see, a cash book is a financial journal. It contains cash receipt and disbursement, and including bank deposits and withdrawals. So generally, it contains anything. It tracks your movement of cash, as I mentioned earlier. It tells you that cash is moving. It tells you that this is happening and this is this and that is that. Is that fine? All right. Now, what are the uses of a cash book? What are the uses of your what are the uses of your cash book? All right. Now, number one is balances of cash and bank can be obtained at a glance. Now, at a glance, now what does this mean? Now, because your transactions, your payment transaction, any transaction that involves you being paid passes through the cash book, it means that from, for example, now at the end of a week, if you want to know the amount of cash, physical cash that you're supposed to have, you don't necessarily have to go to your cash till, your cash box, or wherever you keep your cash and start counting it one by one. So far your cash book has been treated correctly, has been treated correctly, alright, has been prepared accurately, then you can just check through your cash book. The balance for cash, or the balance on the cash book at that point in time, is the amount that you're supposed to have in your cash still. Now, if it does not balance, if it is not the same, then of course there is a problem that you have to look into. But normally, once so far you passed every cash transactions through your cash book, then the balance of cash and bank can be obtained at a glance, even without having to count physical money or physical cash. Is that taken? All right. Now the next one is that the cashier can conveniently keep the account up to date without interfering with the use of the ledger for other purposes. All right. The cashier can conveniently keep the account up to date without interfering with the use um, of the ledger for other purposes. So generally, your cash book is actually a lifesaver, because at the end of the day, you just have to look through your cash book and then you get everything that you have been looking for regarding what? Regarding payment, whether you regarding receipts of cash and payment of cash. Is that fine? So generally, your cash book does not only track physical cash. You know, I mentioned that earlier. And why is that? It is because when we talk about cash in business, for example, when you say somebody, I sold goods for cash, or when we talk about cash sales and credit sales, cash sales does not necessarily mean that you sold goods and then they gave you physical cash. It means that you sold goods and then you were paid for it immediately. Is that fine? You sold goods and you were paid for it immediately. So that's actually the way it works. All right. Now let's now move on to types of cash book. Types of cash book. Now you must know that we have various types of cash book, and this cash book actually we are going to I'm going to show you a format of a cash book, of course. Don't worry. Now because your cash book also serves as a ledger, because your cash book also serves as a ledger. Sorry, let me erase this. Now, because your cash book also serves as a ledger, it means that, of course, as a ledger, it must also be what? An account. All right. So it's going to have a debit side and a credit side. So, or you can say cash account, for example, but let's call it cash book. All right. Now, since it also functions as a ledger, it has both a debit side and a what and a credit side. But your cash book is prepared in columnar form. Your cash book is what is prepared in columnar form. All right. That means that just this account is not sufficient for your cash book. It has to be divided into what? Into columns, into rows, into columns. All right. Which means you have certain columns on your credit side and another set of columns on your debit side. Is that fine? Now, that now takes us back to what? Types of cash book. The reason I had to explain that initially is because when you are talking about types of cash book, you're actually talking about how many columns your cash book has rather. Because the major difference between cash book is the number of columns. Now, the first type of cash book that we have is your single column cash book. Now, let me see, there are several types of cash books that entities can use, whether they are businesses or individuals. They are single column, double column, triple column cash books, and we also have something called the petty cash book. So, while talking about the types of cash book, notice that we have four types of cash book. We have the single column cash book, we have the double column cash book, we have the triple column cash book or the three column cash book, and then we also have the what? The petty cash book. Each of these we're actually going to explain each of these. All right. So now the first one is the single column cash book, and I'm going to show you an like an illustration of that, if like a format of it. All right. Now, when we talk about single column cash book, or let me say when we are talking about the types of cash book, the only difference between cash book is the difference in the amount column. In the amount column. All right. It means that, of course, you know that for any account, anything in account, for accounts generally, there has to be what? There has to be an amount to it. All right. There has to be an amount. And when there is an amount, the difference between the single column, double column, and three column is that under single column, there is only one column for amount. Under double column, there are two columns for amount. Under three column, there are three columns where you what? Where you include amount. And of course, each of these columns have different uses. Is that taken? It's not like you are writing the same amount in each column. Now, when we say single column, it means on both sides. And the don't forget that we have the debit. Don't forget we have the debit and the credit. All right. So that's that. We have the debit and the credit side. So we are saying that for single column on the debit side, there is a single column for what? There is a single column for amount. Then, of course, in the same way, on the credit side, we have another single column for amount. All right. So the single column cash book is the easiest type of cash book to use actually, and it is mostly used by individuals who just want to keep track of their own money and finances. Alright, to use the single column version of the cash book, transactions are noted in one column, don't forget, and it is used to record only money received and paid with cash. Then the balance on the single column cash book is referred to as what? Your cash in hand. Now let's look at the illustration. Now your single column cash book. Alright, now notice that we have the debit side and we have the credit side. All right, we have the debit side and we have the credit side. So you see, we have, look at the columns. So we have debit, we have credit. All right, now we have date, description, folio, and amount received. Now, when we are talking about single column cash book, now when we are talking about column, you notice that we have just one column for amount here. There is only one column that is dealing with what? That is dealing with there is only one column that is dealing with the amount here. Is that taken? All right. But so that's why we have just one column for amount received. All right. And the only kind of transactions that are shown in the single column cash book is what? Is cash transaction. So of course, don't forget you are debiting the receiver, you are crediting the giver. So generally, so normally when cash is received, you can come here and say 5,000 naira. So this is the way you fill it up. You say, let's say we have a transaction like started business with cash. All right. In that sense, we know that cash is the receiver while capital is the giver. So we are debiting cash. So let's say that's January 1. So we say January 1. Is that fine? January 1. What will be the description? The description is a it is like a description of what happened, of course, all right? But you cannot totally write everything that happened. For example, in a typical cash book, you cannot write cash received from, you don't have to describe everything in that details. You just have to give us an hint to where the other to where the transaction is coming from and where the other arm of the transaction will come in. Don't forget the principle of double entry states that for every debit entry there must be a corresponding credit entry, and for every credit entry there must be a corresponding debit entry. Is that fine? So, for example, we are talking about we started business with cash, right? Started business with cash. Now, if you start business with cash, that will be what? Capital. So you write capital here. Is that fine? You write capital here. That's that for your description. All right. In your folio, there will be nothing. And then in the amount, you write 5,000 naira. Is that taken? All right. That's capital. So you would see that because the amount is in cash for a single column cash book, that's why your single column cash book is actually not so common. It is especially not in this case again, because the major difference between your single column cash book and your double column cash book is that your double column cash book has a bank column, all right, which means there is a column for when you receive money through checks and other banking platforms. But your single column cash book just focuses on receiving physical cash. So when you receive physical cash, you put it under amount received. Is that fine? That's the way it works. But your double column cash book creates a separate column for accepting. Alright, you cannot see it. Yes, I'm going to do that. Thank you for that observation. So just let me know if it's okay that way. Alright, let me know if it is fine. All right, that's fine. So date January 1, description capital, there's nothing on that folio, and then you have your what? You have your amount received under the debit side. Is that fine for January 1? Now let's assume that you now bought goods worth 2,000 naira on January 2nd. All right. It means that now when you buy goods, who is the receiver? Don't forget, debit the receiver, credit the giver. You are giving cash. So cash is giving out money to the goods, to buy goods, to purchases. So purchases is the receiver. So you debit your purchases account and you have to credit your cash book, your cash account. All right. Don't forget your cash book serves two functions. It's serving as a subsidiary book for itself and also serving as what? As the ledger. You don't necessarily have to transfer. When you are doing subsidiary books, for example, sales day book, you after you enter your sales day book, you then have to transfer it to your sales account. Your cash book is both the cash book as a subsidiary book and the cash account itself. Is that fine? Your double column cash book contains both the cash book, then the cash account and the bank account. All right. Now let's see if I purchase goods. What will I say? On January 2, we'll say January 2, description will be purchases. There's nothing on that folio, and we are going to have something like the amount that we said was 2,000 naira. Is that fine? So you would see that we are filling up the what's it called? We are filling up the tables. All right. Now let's now assume that on the 20th of January, sorry, on the 5th of January, we sold goods for cash. The 2,000, we bought goods of 2,000 naira, then we're able to sell it. All right. So that's January 3rd. Now, when you sell goods, you are receiving money. Sales is giving you money. So you debit the receiver, that's cash book, and you credit the giver, that's sales. So we come here, we say January 3rd. All right. Now, January 3rd, the money is coming from sales. So your description is just, sometimes your description is also called particular. All right. You can come here and write particulars. So your description can also be called what? Particulars. All right. So another name for description, you can also put particulars instead of so you also have your particulars as the same thing as what? As your description. So you have sales, there's nothing on that folio. Let's assume that the amount was, let's go back to our color, blue. So let's assume that the amount was 3,000. You are receiving money. So let's say on January 3rd, let's say January 5th, you paid rent. Cash is given, so you have to credit it. So you say rent, let's say that was 1,000 naira. Let's say it is 500. Is that taken? So let's assume that you now sold the last portion of your goods on January 17, sold goods for cash, and the amount is 1,000 naira. All right. Now with this, you can do what um you can balance up your account. Now this means balancing means that at the end of the day, this is January 31st. We want to know the amount that remains in our cash still. All right, I want to know the amount of cash that I have left. That's what it means to balance. Is that fine? All right. So I come here. Sorry, I don't have an extra column here, but um, this will still work. Let's have something here. You have to write the total. The total here is 5,000 plus 3,000 plus 1,000. The total is 9,000. You have to repeat that same total here, 9,000. Then you have something called your balance carried down. All right, your balance carried down. Now let's look at it. This means that the amount on the debit side shows the total amount of cash that we received during the period. All right, 5,000 plus 3,000 plus 1,000 means that the total money that we received this month, or yes, this month was 9,000 naira. And out of the 9,000 that we received, we were able to pay out 2,000 naira for purchases and 500 naira for what? We paid 2,000 for purchases and 500 naira for rent. So we are good. It means that if I made 9,000 and I'm paying 2,500, then I must have some money left with me. All right, now the amount of money left with me is what is called your balance carry down. So your balance carry down is the amount that is left at the end of the period. All right, so it's your difference. It is the difference between the amounts that you received and the amounts that you what that you paid out. So 9,000 minus 2,500, that will give you what? 6,500 naira. So it means that at the end of the day, when I go through my financial statement, if I have this 6,500 naira in my cash book, it also means that if I open my cash box, my cash till, or wherever it is I keep my cash, and I count it, I must be able to count exactly 6,500 naira. Do you understand that? I must be able to calculate exactly 6,500 naira. If you have any question about this, please. I'd love to take your questions. If you have any questions at all. All right, then let's continue. So that's that for what your single column cash book. So you would see that for single column cash book, there is just one column for cash. You would notice that every amount that we received or was paid was under what? Was under just one column. But when we get to and that's actually the difference between this one and what and your double column cash book. Is that fine? Now, let's do this illustration of single column cash book before we now move on to your double column cash book. All right. Now, enter the following transactions in the cash book of Olamide. Enter the following transactions in the cash book of Olamide. All right, we have July 1, cash in hand, July 1 cash in hand. Now what does that mean? Your cash in hand is the balance of cash that you have currently. Alright. Now if as at the beginning of the month he has 1.5, it means that as at the end of last month he had what? 1.5. Now this is what we are talking about. At the end of January, based on my hypothetical illustration here, we the our money remained 6,500 naira. Right. Now that is our cash in hand as at the end of January. Now of course at February 1st, if you come somewhere here, you are going to have something like February 1, alright. Then this is balance carry down. Now that balance carry down from last period is going to be brought forward to the current month. So here we are going to have balance brought down or balance brought forward. You can call it anyone actually. You can also call it balance brought forward. You can also call it balance. You can also call it balance brought forward. Is that fine? Right, balance brought forward. This particular amount that was remaining from last period is going to be our starting amount this year, this month. So it's going to be 6,500 naira. And please pay attention to the fact that your balance carry down that is here is what? It is a current asset. It is a current asset. Please take note. The balance in your cash book is what? Is a current asset. Maybe I should write it somewhere here where you can see it. The balance in the cash book is a current asset. Let me put it in perspective. The debit balance in the cash book is a current asset. What do we mean by a debit balance? Now, when you are talking about debit balance and credit balance, you don't use your balance carry down to judge. You use your balance brought down or balance brought forward to judge. Please pay attention to this. When you want to know whether something is a debit balance or credit balance, you don't use your balance carry down. You use your balance brought forward or balance brought down. What does that mean? It means that if your for example, for this cash book, our balance carry down is definitely on the credit side. But that does not mean it's a credit balance because by the time we bring it down and finalize that transaction, it will go back to the debit side. So it is actually what? A debit balance. Likewise, if your balance carry down is on the debit side and you have to transfer it down to the other side, the credit side, then that is a what? A credit balance. Is that taken? And then it is only in one particular scenario where we can have that particular kind of balance, and that's when we have a bank overdraft. So I will just put it here: the credit balance in the credit balance in the cash book is a shows bank overdraft and is a current liability. Is that fine? So that's the way that works. Now let's walk through this illustration very quickly before we move on to double column cash book because of our time. All right. So enter the following transactions in the cash book of Olumide. This is the cash book of Olumide. We have credit side, we have debit side, right? Let me write it here. Let's say we have cash book. Let's change it to black. So we have our cash book. All right. Now let's look at the transactions one by one and then we post it into our cash book. Now the first one, July 1, cash in hand, 1,500. Based on our explanation, that is what? An opening balance. So you come here, we are team blue all the way. Come here, you say July 1. Description. Balance brought forward. Balance brought forward. No folio. The amount is what? Amount is 1,500 naira. 1,500 naira. So that's that. Now the next one is what? July 3, cash to Adekunle. July 3, cash to Adekunle. So it means we paid cash to Adekunle. Alright, so we come here, we say since the payment, so you are crediting your cash book. So you say July 3. Who are you paying to? You paid to Adekunle. Alright. How much did you pay to Adekunle? We paid 250. Is that fine? Then the next one, July 5, cash sales. Don't forget when we have cash sales, sales is giving, cash is receiving. Alright. So that is what? That is going to the debit side. That's July 5. Please take note the date. You say July 5. Sales at how much? 500 naira. Then you have cash purchases. That's July 6. That's going to your debit side. So July 6. Come here, you say purchases. Come here, you say purchases of 750. Alright. Then the next one, you have bought stationery. You are buying stationery on July 7. If you buy stationery, that's also a credit transaction because money is leaving, alright. So you have to credit the account. So you say July 7. What did we buy? Stationery. Stationery at how much? At 50 naira. Then we also paid insurance on July 9. We are still paying, so that's still credit. Insurance, that's 30. July 10. Let me do July 10. Just directly on that. So July 10, you also paid wages. and the amount for that is 25. Then on July 12th, you made another cash sales of 115. So that's it. Then what do you do? Just like what we did in the previous one, you do what? You balance it up. Since you have done all this, you have recorded all the transactions, then you balance it, you write your total here. You have 1 5 plus 500 plus 115. That gives you 2115. Yeah, 2115. Yeah. We also have 2115 here, right? But of course, on July 31, you'd notice that your credit side is not up to your debit side, Abby. So the remaining will be transferred as what? That's your balance carried down, the amount that remains after the whole thing. Alright. So you have 250 plus 750, that's 1000 plus 50, that's 1050 naira, 1080 naira, and 1105. Alright. Now 1105 minus this, that gives us 1110. So our balance carried down is what? 1110. Then we will now have something little here at the end. It's still in the same table. Our table is just not big enough. That will be August for the next month. Don't forget the closing balance for last month has to now come in as the opening balance for the month, as balance brought forward or balance brought down, as the case may be, and that is 1110. Voila. So that's it. All right. So, so I hope we get that. I hope we understand that. All right, thank you. That's fine. So now let's move on to the second type of cash book. That's what our double column cash book. So your double column cash book is actually still maintaining the same format. The only difference is that this amount received column is now divided into two. So instead of you having 4 columns on every side, you now have 5 columns on every side. All right. So your double column cash book is under the amount received. Your double column cash book now divides the amount received into amount received from bank or through bank and amount received in cash. Is that fine? So it allows users to keep more detailed notes about their transactions. It shows the total of money received and paid by the firms, either by cash or check. Is that fine? So while under single entry, single column cash book, you only have how your transactions moved, whereas you only have cash transactions. Now, for your double column cash book, you can show both transactions in cash, I mean physical cash, and bank. That is money received through check, wire transfer, bank transfer, any any movement of money that involves the movement that affects the bank now enters what? Your double column cash book. So you would see the reference here. We have date, we have description. Your description is still your particulars. We have folio, we have cash, then we have bank. On the this right here is our debit, while this side is our credit. So on the debit side, we have the same thing. All right, date, description, folio, just as we had under so just as we had under the other under single column cash book, we have what we also have here. The only difference is that now your amount received has been divided into two, and that's why we are calling it two column. It means that single column means there is just one column for amount, double column means there are now two columns for amount, your cash column and your bank column. Is that fine? So that's that. So you see that your date is still there, your description, which is your particular, is still there, your folio, your cash, your bank, your date, your description, folio, cash, and bank. Right now, this is where your folio is now going to be important. Now, you notice that we did not use the folio part at all here in our single column cash book. We didn't use it at all. But your double column cash book, due to the existence of something called contra entries, we are going to need what? Our folio column. Is that fine? All right. So I hope you understand what double column cash book means now. I hope you understand it. All right. I think I'll just continue that way. So double or two column cash book. So that's basically what it is. There's just a slight difference between it and single column, and that's the difference between the number of columns that exist for cash, for money, amount received and amount paid. All right. So that's the way it works. So now let's talk about something very, very vital and important in double entry column cash book, and that is what is called contra entries. All right. Contra entries. Now, when you say contra entries, now when we are talking about cash and bank, I mean a transaction where, or let me say an entity that uses both cash, like they maintain both cash account and bank account, which means that they keep physical cash, but they also have what? A bank account where they keep money. Now, there is the possibility, of course, that, okay, let's not even think about it in terms of company. Let's use you, Princess, for example. You have a bank account. I want to believe you do have a bank account. Is that right? Of course, you have a bank account. Then you also have money in your, you might also have physical cash. Now, don't forget that before, most likely before you had that physical cash, you actually had to go and withdraw that from an ATM. All right. So in that sense, you are withdrawing money from your bank. Now, for businesses too, businesses generally they keep spare cash. I mean, physical cash. Then they have money in the bank. Now, there are times where they have to move money from one place to another between cash and bank. I hope you understand what I'm saying. They might have to move money from cash to bank or from bank to cash. What does that mean? The entity might just have too much money. For example, they just finished the transaction and um they sold goods, and then the person decided to pay in cash. Let's assume that you run a business and then you just sold something for 500,000 naira, and the person insisted on paying in cash, for example. All right. Now, once you do that, in your double entry, your double column cash book, you would already show that you received money here. Alright, so please pay attention to the table. So you would say, so let's say the transaction is from sales. You say sales, alright, and you put it under cash as 500,000 naira, right? But you're looking at it, you don't have the facilities to keep that much cash. And like, where do you want me to keep 500,000 naira? I cannot actually keep 500,000 naira. I must actually find a way to do it. Of course, the best way to do it is to transfer that money and put it in your bank account. All right. Now, don't forget, you have already shown, or you are already showing that you have 500,000 naira cash in your, based on what we can see on your cash book. Now, wants to move from this location to this location. Is that fine? From your bank, sorry, from your cash to your bank. Now, in that sense, a contra entry occurs when both the double, like, for every corresponding credit entry, there must be a corresponding debit entry. Now, contra entry occurs when you finish a double entry in just one account. I mean, both the debit entry and the credit entry of that transaction happens in the same account. And that is what happens in a double column cash book. Why do I say that? Now, you have received this money in cash of 500,000 and you want to transfer it to your bank. If you want to transfer it to your bank, you have to remove it from your cash to show that money has left cash. Then you have to also show that your bank is receiving. So there are two parties now. Your cash is giving money, you have to credit cash, but your bank is receiving money, so you have to debit it. But both cash and bank are inside the same account. That is what we know as what? As a contra entry. Is that taking? It can also occur on the other end where you need more cash but you don't have physical cash. Then you decide to actually take money from your bank and withdraw it and use it for whatever you need it for. Is that fine? Just for you to have money in the cash still. So in the case of this, in the case of my hypothetical example now, we are going to have something like we want to remove money from cash. So I have to credit cash back with 500,000 to show that money is living there. Now, don't forget our description explains where that money is going to. If money is leaving cash, what did we use it for? We sent it to bank. So the description will be what? Bank. In that same account, you also have to come to the debit side because bank has now received 500,000. So you say bank 500,000. Then under your description, if you want to ask where is the money coming from, the money is coming from your cash purse, from your cash still. So you just write cash. Is that fine? You just have cash. Now, because there is a contra entry to show that this particular transaction is actually a contra entry, there is something that is used to show that, and that is called folio. All right. So you just come under your folio and you write C in front of the two transactions. You come here too and you write C. Now, any knowledgeable person, once they see C, they know that this particular money is coming from your this particular 500,000 naira that we can see in our bank. Let me highlight it for you. This particular 500,000 naira came from where? So this particular 500,000 naira came from cash. While this 500,000 naira, this one is showing that 500,000 naira left cash and went to bank. Is that taking? So this C there just shows that it is what? It is a contra entry. So Still in that same line, I'll just summarize it in a little while. I'll just explain it based on what I have here. Now we say contra entries occur when the double entry of a particular transaction is completed in the cash book. So when the double entry of a particular transaction is completed in just one account, that is what is called a contra entry. So when you have to both the debit side, the debit entry of that transaction and the credit entry of that transaction would be completed in that same account, then that is what a contra entry. Now in the cash book, it is only possible either when cash is deposited into the bank account, just like the example of 500,000 naira that we used here. When I had 500,000 naira excess cash that I don't know what to do with, I can transfer it to the bank. In that sense, cash is moving from the bank. Sorry, cash money is moving from cash to. So look at it in this way, that you have a box where you keep your cash. So money is moving from that cash box to your what? To your bank account. Then of course, it's also possible for you to need more cash in the business and then you just withdraw and put it in the cash box. So in that sense, money is leaving the cash, is leaving the bank and is moving towards to cash. Of course, in that sense, our transaction here will be the other way around. The 500,000 will be received by cash, while the 500,000 naira is paid by cash. So we'll credit bank and debit what? And debit bank. Now let's see this cash paid into the bank. Now, when there's surplus of cash in hand, just like what I said, the firm can pay it into the bank. Money will leave the cash till, cash box or whatever you want to call it, and would be deposited into the bank. Now, what's the effect of this particular transaction? It means that your cash balance is reducing, but your bank balance is increasing. And because of that, it means cash is the giver and bank is what? The receiver. So you have to debit the bank column of the cash book and you credit the cash column of the cash book, just as I illustrated in that example. Is that fine? Then the second one is when cash is withdrawn from the bank. Of course, when there is insufficient cash in hand, the firm can withdraw from its bank. A check will be drawn and what? And cash received. Of course, life has changed a lot now. You don't necessarily have to even have a checkbook before you can withdraw your money from your bank. Is that fine? You can use ATM, all right? You can use your debit card on an ATM. You can use many other ways. All right. Of course, it also depends on the type of account that you run, whether it's a savings account or a current account or a fixed deposit account, as the case may be. All right. So cash withdrawn from bank just means money is moving from cash to bank. Now, the effect of that transaction is that your bank balance is reducing while your cash balance is increasing. Your what? Your bank balance is reducing while your cash balance is increasing. So what's the action? You have to debit the cash column because now the cash is the receiver, but the bank column is what? Is the giver. So you debit your receiver, the cash column, and you credit your giver, the bank column. And don't forget, your contra entry is always labeled C under the folio column. That is column rather. That is when you, after you debit your cash and credit bank, or you debit bank and credit cash, on the two sides under folio, both debit and credit side, you have to include what? You have to include C. You have to put C to show that what? There is a contra entry. A contra entry has occurred here. Now the next thing we want to talk about that is also peculiar to double column cash book that you cannot find under a single column cash book is what is called bank overdraft. Bank overdraft. All right. Now, what does bank overdraft mean? Overdraft. Overdraft. It basically means when you withdraw more than you have. It's as simple as that. I have 500,000 naira in my account, but I was able to withdraw was 600,000 naira. There is an overdraft of 100,000 naira. I overdrafted my account by 100,000 naira. Now that does not just happen, it does not happen at random. What I'm saying is that it's not that you can just wake up and say you want to collect more than what you have in your account. It happens as a result of a kind of arrangement that exists between the banker, that is the bank and the customer. Is that fine? So as a business owner, I can, of course, it's not available to savings users is available to users of current account. Alright, so if I use a current account and I have 500,000 naira in my account, I can make an arrangement with the bank that hello, I actually need 700,000 naira, but all I have in my account is 500,000 naira. Then of course there would be a an allowance for me to withdraw over and above my credit balance in the bank, over and above the amount that I have in the bank. Now, of course, when this happens, it means that I now owe the bank, because if I had 500,000 naira in the account now, but they allowed me to withdraw 700. It means that I withdraw 500,000 naira that was for me and 200,000 naira that is for the bank. So I now owe the bank 200,000 naira. That means that bank overdraft is what? It is a liability. And therefore, it creates a credit balance on the bank column of the cash book. Are we together? It creates what? A credit balance on the bank column. Don't forget what I explained about credit balance and debit balances. All right. Now, once your balance brought forward is on the debit side, that's a debit balance. But for bank overdraft, it means that your balance carried down will be on the debit side. Then by the time you bring it forward to the other side, by the time you want to bring it forward, you have it on the credit side. That's a what? That's a bank column. Sorry, that's an overdraft. And what does that mean? It is basically trying to tell you that your credit side, the credit side of your bank account is greater than the debit side of your bank account. Don't forget, debit side of the bank column means the amount you receive, while credit means the amount that you what? That you paid. So the bank can allow you to pay more than you need. For example, let's assume that you know that I already transferred 500,000 naira to my bank account here. Is that fine? Then a transaction now happened. I now had another transaction where I wanted to purchase goods, purchases, and I wanted to pay by bank, by check. But the total amount I have there is what? It's just 500,000 naira. That's the total amount I have in my bank. All right. But the amount is what? 700,000 naira. So I took out an overdraft and said 700,000 naira. Now, by the time I'm balancing my books, you would see that the total here will be 700,000 naira under bank column, another 700,000 naira here. It means that my credit side, which is payment, is already greater than my receipt. I have beaten more than I can chew. That's an example, right? I have I have spent more than I have. All right. So that's a liability in that sense. So you have a balance carried down here. So instead of you to normally have your balance carried down here, I mean on the credit side, now your balance carried down is now coming on the debit side. Is that fine? And that balance carried down is what? 200,000 naira. All right. 200,000 naira. With that, at the end of the day, I would have to bring it forward to the next period and say balance brought down or balance brought forward, as the case may be, it's the same thing. All right. And that will be what? 200,000 naira. So you see, it is what? A credit balance. So I say you judge debit balances and credit balances by what? By your balance brought down, not by your balance carried down. So when you see balance carried down on the credit side, know that that's the debit balance, because at the end of the day, it's going back to the debit side. And when you see balance carried down on the debit side, know that that's the credit balance, because at the end of the day, it's going back to the credit side as balance brought down. So 200,000. Now this balance brought down of 200,000 is what? Is a liability to me. Is a what? Is a liability to me. Is that fine? It is a what? It is a liability to um to me. All right. So yeah, that's that about bank overdraft. So that's why we say bank overdraft is a liability. Now the next one that I want to talk about before I move on to three column cash book is called your dishonored check. Now traditionally, whenever you want to withdraw money normally as a okay, this is the way it works. As a business owner, whenever that as a business that owns a current account, right? Now please, if there is anything you don't get along the way, please kindly draw my attention to it before we move too far. Is that fine? All right. So please, I would be expecting if you have any question regarding anything that we have discussed. So now let's talk about dishonor checks. I run a business and we buy and sell. All right. So let's assume that I bought goods worth 500,000 naira. Now, traditionally, I would not transfer. You know that nowadays what you would have to do is what? You just have to make the transfer and that's all. All right. But in this case, traditionally, what you do is you issue a check. All right. So you just write a check for the supplier, and the supplier just has to go to your bank and cash out the check. Is that fine? But there is a possibility that you issue out a check and then that check is dishonored. When you say a check is dishonored, it means that it was rejected. So I wrote you a check of 500,000 and you took it to the bank and they rejected it, which means they did not pay you the required amount. All right. Now, I'm not going to go too deep about dishonor check. I just wanted you to understand that, like what it means. When when we want to talk about bank reconciliation and all of that, we are going to go further into how the effect of dishonor checks. But what it just means, I'm going to explain it better when we get there. But what it just means is that if I give you a check and they reject it at the bank, don't forget that as I'm giving you the check, I am assuming that money is already leaving my bank account. So I already credit the bank column of my cash book. I'll put that on credit already. Is that taken? Is that fine? But my bank account would actually still have money because I mean the check was not honored. Is that fine? But so it majorly has an effect and cause discrepancy between the bank statement and the bank column of the cash book. But when we get to bank reconciliation statement, we're actually going to discuss that better. So dishonored checks are checks lodged into a bank but were rejected by the bank. This might be due to so of course it's not that you just take a check and then they will just automatically send you back. All right. There are certain things that actually cause it. All right. Now, for example, there might be insufficient funds in the account. It is possible that I didn't know that maybe I did not have up to 500,000 naira. Maybe they have deducted bank charges and I did not know. All right. They can also reject the check due to irregular signature. All right. If my signature, the signature um of the owner of the check does not correlate with the signature that the bank has. So if the signature on the check does not correlate with the signature of the bank, this is to prevent forging, because some people can actually forge signatures on checks and use that to cash out money, from banks. Another one is wrong date or amount. For example, um, you are bringing a check dated 1st February. Today is 28th of January, right? But you are bringing a check that is dated 1st of February. That does not make sense. How do you receive check at a future date? So that works. Another one is wrong amount. Wrong amount. Another one is difference between amount in words and figures. So for example, you wrote 500,000 naira only in words, but when you were writing your figures, you mistakenly wrote 590,000 or 509,000. That's a discrepancy between the amount that you wrote in words and the amount in figures. And that's actually why banks require you to do that, to write in words and also write in figures, so that you would be sure they can confirm it that you're actually writing it. Um, so that's that. Oh. Uh, and let's see. Before we move on to three column cash book, I think we should. If there is a way we can just prepare this double column cash book based off of what we have here. Ah, I don't want us to go back and forth, back and forth, back and forth. All right, the following transactions took place in the business of John during the year. Before we go on, let's just draw. Let's see how this is going to work out for us. So, sorry, sorry, the hand is not straight. So we have for John cash book. We're preparing a double column cash book for him. We have the credit side here, and we have the credit side here. Not sure how this is going to work out. I think I can. I should probably just erase this, erase this, and let's extend. No. Let's extend this a little bit. Ah, how are we going to do our cash book with this? We have dates. We have our particulars, our folio, we have the cash column. Sorry. Alright, we actually have limited time left. So I think let's leave this question for now. Let's discuss three column cash book, and then in our next lecture we'll complete the cash book by solving that particular question. But please, I hope you understand every other thing that we talked about. We're just not able to solve that particular question, but I've given other illustrations. We even though we're not able to solve that particular question, um we have given illustrations that I've given illustrations that can actually help. For example, this one. Alright, so you can look through these transactions and then please pay attention to it, and then you should be able to draw up a cash book from this. Right. But if we look at the transaction, let's just say what would be done for every transaction. What account are we, what side of the cash book is it going to be? Is it debit? Is it going to be credit? Now the first one is January 1, we have cash in hand. Don't forget, your cash in hand is the beginning of cash for the beginning. It's the cash that you have at the beginning of that period, alright? So it's your balance brought forward. So you have, but those, if you see that we have cash in hand and cash at bank. Alright, your cash in hand is the amount that you have in your bank as at the beginning. That's your cash at bank. But your cash in hand is the physical cash that you have for that period. So if you want to record this, for example, Under here, you have balance brought forward. Then you have cash in hand of 250. You put your cash in hand of 250 on your cash column, while your cash at bank of 1 will be in your bank column. Then the next one is purchase goods by cash. Of course, don't forget, when you are purchasing goods by cash, you are giving money. Cash is given, so you credit cash account. All right. But you now put that 300 naira. Is it under cash column or bank column? You put it under cash column. All right. Sold goods for cash. Your 600 naira will be on the debit side under what? Under cash column. Purchase goods by check. 200 naira. It will also be on the credit side, but the 200 naira will be under what? Under bank column. So you have seen the difference. Whenever they said anything involves cash, it is going to be under the cash column. But if it involves check, then it is going where? It is going to the bank column. Is that fine? So sold goods for check, bank column. Received check from Ray, bank column. Paid Ella by check, bank column. Received check from Sam, bank column. Paid Johan by check, bank column. Purchased equipment by cash, cash column. Paid electricity by cash, cash column. Withdrew cash from bank for business use. What is that? A contra entry. When cash is withdrawn from the bank for business use. So bank is giving cash. So what you do is you remove it from bank by crediting the bank column, and then you put it in cash by debiting what? The cash column. Is that fine? So withdrew cash from bank from family use. Please don't get confused. Whenever money is withdrawn from bank or from cash from the business generally for any family use, any personal use that is not for the business, it is tagged as what? As drawings. Whether they withdrew it from bank or they took it from the cash. All right. Now it's going to be referred to as what? As drawings. Now because it was withdrawn from the bank, then that means that because it was withdrawn from bank, that only tells us that um, the drawings will be recorded on the credit side, of course, because money is leaving. All right, but that 600 now will be under the bank column. But withdrew cash from bank for family use is not a contra entry. But the transaction on January 20 withdrew cash from bank for business use is what? Is a contra entry. Now we also have purchased equipment for home use 350 naira by cash. Purchased equipment for home use 350 naira by cash. So that's cash column. Cash sales banked. Cash sales banked. Cash sales banked 3,500 naira. That is what? A contra entry. Is that fine? Cash sales banked. Now another one is received check from Tammy, paid check to to Joe. All right. So that's of course, the columns where that one is going to go to. Whenever you hear check, then you know that of course it's definitely going to your bank. It's definitely going to your bank column. Is that fine? All right. Let me see. Can we still? Okay. I think we can conclude the lecture today on single column cash book and double column cash book. Then in our next lecture, we are going to discuss your three column cash book and your what? And the petty cash book, and then that will be all for cash book. All right, as I would fondly say, this is this and that is that. So that is that about that. So that's on single column cash book and double column cash book. Thank you so much for listening. In our next lecture, we'll continue into three column cash book and petty cash book. Till then, I wish you well in your preparations for your examinations. Do well to take care of yourself. Bye for now.